They do not ask nicely.
No, but they can also just force sell your shares. They do not even have to ask which shares if you have more than one type of holding in your company.
You've just jumped into our masterclass about bad investments. And sometimes you might think that you are safe until you are not. Today we're going to talk about something called the margin call, which is a devastating thing that could happen to you on the market. And to explain that to us, we have Kat, our business lawyer here.
Hello.
Welcome.
Tackar.
Today we're going to talk about the margin call.
And margin maintenance.
And margin maintenance,
yep.
Which we're also going to show you how to calculate it.
Yeah, good to know.
This episode is powered by Key Solutions. We're so happy to be here. So this is for you who is curious about investment but do not want to make a bad investment and go bankrupt. So that's why we are here today.
Could be a good one.
Could be a good one. Also.
And we did another show showing how leverage finance and trading on margin works.
Yes.
With the big risks, but also the upside.
Yeah.
So you can watch that if you want the basic.
Yes. We're going to show some upside, but we're also going to show you what can happen.
Yeah. Today is mostly about the downside.
The downside.
Yeah. No, but margin account, you trade using a loan. So a cash account, you use your own money.
Yeah.
You can win.
Yeah.
And you can lose. Right?
Exactly.
Lose what you put in. If you use a margin account, you take a loan. So we talked about the 2-for-1, which is typical. That if you put in 100 of your own hard-earned money, then you get the equivalent, the same amount as a loan, 100.
So then you have the double 200 to invest.
Yep. Which means that even if you only have 100, with the same development on the market, stock market, you can make twice the profit because you leverage it through the loan. And you can make twice the loss. Uh-oh. So bigger risk.
Yeah.
But on top of that, if the development of the market goes down, we can also end up in a situation where your broker, where you have your account, makes a margin call. Like the famous movie.
Ah.
Yeah. And the reason is that they have a requirement that the equity part of the account, they have a requirement that the equity part of your account must be at least 35% ongoingly. So the value cannot drop in infinity because they will pull the plug because they want to protect their investment.
Of course.
And then they can call you and make that margin call. But they can also just force sell your shares.
They do not ask nicely.
No, they don't even have to ask.
Oh.
They do not even have to ask which shares if you have more than one type of holding in your company they want to sell. They can just go and do. So if you drop down the margin maintenance ratio that your broker has in your agreement, you have to look at that. The FINRA, the US regulation, says that it must be at least 25%, but typically will be higher. And it can also be calculated in different ways. It can look at what specific stock you're invested in, or it can be on your total portfolio. So you need to know, and also know that they can change it ongoingly. They might be at 35 and you feel like you're safe, and then they might turn it up to 45.
Okay.
And suddenly they can force sell your shares if the value of your equity stake goes down.
So you really need to be aware of this percentage.
Yeah. Incredible.
Good to know.
Yeah. Because if they do sell close to your position, then any loss will be realized. You cannot salvage it. But if you get the margin call, you can also put in other equity as collateral, which means that you raise the equity stake of your account, or you can put in cash to cover them so that they will not force sell, so they will not close your position.
Okay, so there is a solution, but...
Yeah, to raise your equity.
But then you need to have some backup for that.
Yeah, exactly, if you can. Okay, so how do we calculate? Because you need to understand if you're safe or not. How much movement in the stock can you take before you end up falling below your margin maintenance ratio?
Exactly. How do we know?
How do we know? So what we do is that we will look at the total amount of your account. And in this case, it's 200, right?
Yeah.
Total value. We will start at the beginning. So account value minus the loan, because the loan part will never move. They're not risk sharing with you. So that
Okay.
will be the same. And loan, here we said the margin amount, 100. And then we'll divide that with the account value. And we get the percentage here. So,
Okay.
yeah. So in this case, if we start from the beginning, the account value will be 200
Yeah.
minus the loan, 100.
Yeah.
And then we divide it into the with the account value again, which was 200.
200, exactly.
So then we get 50. So then your equity stake is 50%, right? 100 of 200. And that's also the 2 for 1. That's where we start off. And let's go for 2 examples when the stock price moves after we initiated the margin.
Yes,
trading.
so now we're going to show you some examples.
Yeah.
So let's start. So if we start with a share cost at 130.
So it increased from 100 to 130.
So that's...
meaning that the movement is 30%. And given that we use margin, our result will be up 60.
So we 60,000.
And the margin account value will hence be 260.
Exactly. So that's a fast move.
Yeah. And I mean, depending on the size of the stock, what you're trading in, it can be very volatile. So
this is just because the stock went up 30%.
yeah.
Okay.
And since it's leverage finance, if it was not leverage financed, you had only invested your own 100, then the result would have been 30 plus and 130 in total. But in this case, you doubled your profit thanks to leverage finance.
Yeah.
But then we look at the margin ratio. Then we take the new account value, which is 260, minus the loan, still 100, and divide it with the total account value. And then we have
62%.
62%. So that's good. We're safe. We're no problem. Margin call?
No,
No.
because we are not below the 35%.
Exactly.
Good.
And then let's take a negative example.
Yes, so let's say that the stock is worth 75 only then though.
Yeah, so it dropped with
25%.
with 25.
Yes.
So then the result?
That would be minus 50,000.
Yeah. Again, if you had not used the margin, only your own 100 cash, you would be minus 25,000.
Exactly.
So we doubled the loss thanks to us using leverage finance, the loan.
Yes.
Yeah. So the account value will be 150 now.
Yes.
And then the question comes. So then we take the new lower account value, 150, minus the loan. Again, that will not be moving because they will not risk share. Always 100. And then we divide it with 150. And what do we get?
We get 33%.
Now then.
What happened
Will
now?
we get a margin call?
Yes, because now we reached below 35%. No.
No.
So this is where the shit is going down.
Yeah. So then the broker has a right to force sell your shares, close your position, or he can call you and ask you to either close the position yourself, pay back the loan, or cover the remaining 2% with cash or other equity that they can use as collateral. That's the margin call.
Okay. So when this happens, if the shares drops even more, can it get worse?
Absolutely. Should we go with another example? Say that the share price drops to 25.
25.
Yeah. And then we have a share price movement of 75%. Result.
Then it's
150.
150.
Again, doubling.
So this can just spiral down.
Yeah. I think we lost a 0.
Oh, here it is.
And then the account value?
It's
50.
Yes.
No, it's 50. Perfect. And then what do we have in margin ratio? Account value, 50, minus the loan, 100, divided by 50. And then we have a margin of?
Minus 100%.
Yeah.
So the catastrophe has arrived.
Yes.
This is dramatic.
Yeah.
And this is why it could be a bad investment.
Indeed. And also when you get the margin call, if you need to close your positions, you might even have been short selling. We'll have a specific episode on that.
Yes, we will.
Yeah. Then it also might be the case that it will be a short squeeze, meaning that many short sellers of the same stock need to sell at the same time while the stock price is rising, which means that your loss will be higher and higher, and that development can go really fast. So it can be very dangerous because you need to close your position, right? So you need to buy while the market is climbing. And you might not even know how many shares, the float, as it's called, are available for you to buy. Because the fewer shares are to buy, the more buyers, the higher the price climbs quickly. So you might be in a real squeeze. And then if you get a margin call, you might be forced to sell, making an incredible profit. Loss.
An incredible loss.
Loss. Short selling, unlimited loss.
It is?
Yeah.
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 So, I mean, this is what can happen if you decided to invest and do not know what you're getting yourself into.
Yeah. And also, me as a lawyer, I don't read all of the agreements I sign. Going to a bank or something else like formalities or opening an account, yeah, sure. But if you open a margin account, make sure you know when they can make that margin call, what happens, what rights do you have, or rather, what rights do they have to force sell, liquidate? What is the ratio that you need to maintain? Do you have a plan? Can you put in some other equity from another account to cover so you're not so they don't force sell? Or do you have cash you can put in? Or is it too great a risk exposure for you? So in this case, strong legal recommendation, read the agreement, ask your financial advisor. This is not legal advice, this is not financial advice. This is us helping you, giving you the tools to understand, to make the good investments and stay away from bankruptcy and bad investments. Because this really is high risk.
Yes, it is. Thank you so much for explaining this. And now you know how this works. So you know, if you are getting into this, you know exactly what it's about. Remember to ask all the questions before you start.
Yeah. And let us know about your bad investments.
Yes, we'd love to hear that. And if you want to stay ahead of the game, you need to like and subscribe and share our channel, because we're going to keep sharing this valuable knowledge for you that you can use in your everyday business life. Thank you so much for today, and thanks, Kat.
Thank you.
Until next time. Hej då!
Hej då!